Gifford. I work with CBRE. I am the Senior Managing Director of Investment Banking for Latin American and the Caribbean. I am based in Miami. I joined the firm in 2005 as the head of capital markets for the region. We have teams in a lot of different countries. We have capital markets teams. We have debt teams. Many of those individuals, they roll up to our team here in Miami. And we're active in raising capital, structuring both debt and equity on the capital raise and structuring.
And before we leave, what would be your top 4 or 5 top markets that you'd say today in the Caribbean, Central Latin American region that are getting funded that you kind of say these are still very, very strong markets?
So Costa Rica is probably one of the strongest. The issue we have in Costa Rica is entitlements and the ability to go vertical or begin construction. If you have a fully permitted and ready to build site with an international operator or international brand, there's good appetite. There is strong appetite for that market. In particular, hotels that are sun and sand focused or tourism focused, not urban business hotels. That is much harder in any market. So Costa Rica, the Mexican Riviera, while it's Mexico, it's still the Caribbean. That remains an interesting market because there is a lot of institutional capital moving in to underwrite and acquire assets. And there are a lot of US dollar lenders that are very active in that market. Currently in Mexico, you have lenders that are really only looking to do hotels, USD, and sun and sand, and then industrial. Guyana is a very kind of hot topic market. There are a lot of groups that are looking at that. It's going to be, selective in terms of, so that market will remain very hot, but I think in terms of lending and transactions or deals or loans getting done, that is going to be a selective few that will get approved and will be going vertical in short order. We do see a lot of activity out of Jamaica, and that's Jamaica, not so much of money going in, but a lot of the lenders that are based in that market are active and looking throughout the region. Dominican Republic, particularly the Punta Cana, the eastern side of the island, we're seeing a lot of international interest and demand from there. And another market that has a lot of potential and that we would expect to see begin picking up more is also Puerto Rico. Puerto Rico is probably one of the most interesting markets in the region. It has a great potential. Money is following the recuperation in ADRs, recuperation and occupancies in different markets throughout the region. And so that's where we're seeing a lot of activity.
That's dear to my heart. Always good to hear Puerto Rico on the list.
So if we take a relation to where we are from 6 months ago, where we really have seen is there was a general expectation. I don't think it's just the Caribbean, but across the markets, everyone kind of had an expectation that we begin to see the Federal Reserve demonstrating signs at an earlier basis of reduction of rates. So I think the majority of people at the beginning of 2024 thought by this, by the end of the first quarter, that we would begin to see signs of the Federal Reserve reducing rates. When we talk about the Caribbean, typically people are looking at and using as a base rate would be SOFR, SOFR. Currently, I'm not positive of today, it's around, yesterday I think it was around 5.3. We're seeing anywhere from a 400 to 600 basis point spread for new construction in the Caribbean, hotel or luxury residences. So it's that kind of 11.5. So it's 10 to 12. If we're talking about an all-in rate, is more or less the range what we're seeing in the Caribbean. 400 to 600 bips currently, or basis points over SOFR, is kind of the average.
All right. And does that loan to cost number still kind of hold about 50-55%, or has that changed any bit?
So loan to cost 55 to 65 on a loan to cost basis. On a loan to value basis, more or less LTV 50%, but on a loan to cost basis 60. Some lenders are willing to go up to as high as 65 on the right projects.
Great. I appreciate you just setting the stage on kind of where the money is at in terms of the cost. And so we were talking about kind of sponsors needing to be a little bit more aggressive with guarantees, recourse loans. Kind of what's that looking like today?
First analysis, and maybe more important, is what are they trying to contribute in terms of the land? What is the land value? And then two, how much equity the investor, developer, sponsor is bringing to the table? And do they have any type of pre-sale or other demand for the project that they're looking to finance? The recourse, non-recourse then kind of comes down to a little bit about experience of the sponsor, the project location, and sometimes the lenders are then coming back, their risk committees, investment committees are asking for, looking for a little bit more additional guarantees from the sponsor. But we do find lenders willing to provide or underwrite loans on a non-recourse basis.
Kind of what are you seeing today with land lift?
But for the most part, the lenders are very, very conservative about underwriting, accepting any land lift. They really want to see what the cost basis is, including cost of land and then cost of improvements. And that's really what they want to use as their basis for lending and for accepting that as a potential sponsor equity into a loan structure.
Okay, so just to get it clear, because I think there's some confusion on that. So if we purchased, let's say, a beautiful beachfront parcel for $1 million, and then we spent $500,000 on all the entitlements, so that's 1.5. What you're kind of saying is that is really what the lenders today are looking at, my value for the land, not a new appraisal that I would present that shows it at 6 million.
100%. That is absolutely correct. So if they do have the lenders will request and will require an appraisal for the land or the project, but they're going to also request and require supporting information to establish what the developer cost basis is. Cost basis acquiring the land, cost basis in terms of improvement to the land. And that's typically what they're going to use as a reference value. Even if the market is a 2x to today in terms of what comparable land sites may be. And so that's very, very difficult to see lenders today really willing to underwrite much of a land lift at all, or any land lift, to be honest.
And we've been seeing a lot in the hospitality sector in the Caribbean, condo hotel pre-sales. So a lot of the hotel developments have had, building out the hotel, but also doing condo hotel unit sales in order to bring in some equity into the deal. Are you still seeing that kind of a transaction? And kind of what are your thoughts from the banking side about those type of transactions?
So absolutely, we're seeing that more and more, and that it's twofold. One, lenders want to see a mitigation of market risk. If pre-selling all the condominiums, they're able to get to a level of say 30 to 50% of the units pre-sold. That is able to demonstrate to the lender that one, there is sufficient demand for the project and the cost basis that they're looking, or the market value that they're looking to place the units at, and that is many times becoming a lender requirement to be able to provide a loan for that new construction, because that is mitigating that risk, and they're not coming in and taking 100% of the hotel risk.
That's actually a very good segue to kind of my last question for you, was about this kind of syndication or splitting of loans between financial institutions, maybe not just between products, right, hotel or condo hotels, but in general. And so kind of 6 months ago, we were starting to see that happen more and more. Kind of what's your take today on the syndication of loans in the Caribbean region?
It's almost a necessity for the majority of new construction loans. Few lenders want to take down 100% of the exposure. Many of the lenders, what they are looking to do is club or syndicate a loan structure, just because they don't want to have full exposure or be the only underwriter on the loan. Typically, your lead will have 40 to 60% up to, in terms of a range, and then under lenders coming in at a smaller portion. So for example, we're working on a loan right now. We're actually working on a new construction loan in Costa Rica. It's a condo hotel, branded condo hotel, North American operator. That's a rather large loan for that local market. We have a principal lender that is going to kind of act as lead, and we're out helping them syndicate the loan. Then what CBRE typically does to get these done is we will go out and we will help source all of the potential lenders and lender interest by doing a market read. That way we can go back, and if we do have a lead arranger or lead lender, we can bring and help them, or kind of already bring syndicate interest to the table to help them basically execute, secure, and execute the loan.
Are you generally contacted by financial institutions, or do developers ever reach out to you?
So it's mainly developers. So our typical client base is a developer looking for financing. Typically, it's not lenders that are reaching out to us. What the lenders reach out to us are typically for advisory roles or workouts.
Really appreciate the time, Tim, that you've given. I understand.